individual taxpayers can now use huge new tax write-offs starting in 2025. And it's all thanks to the new tax bill now in effect. I'm talking about deductions the IRS is basically begging you to take advantage of. Yet millions of Americans still leave this money on the table every single year. And not because they don't qualify, but because they simply miss out on one or more of these. So in this video, I'm breaking down 11 new or updated write-offs you can use to keep most of what you earn. These are the same tax write-offs I use for my clients at keepmost.com. So let's start with the one that has a lot of people excited. It's the new auto loan interest deduction. You see, starting in 2025 and running through 2028, you can now deduct up to $10,000 per year in interest on a brand new car loan. That's right. Personal auto loan interest, which was never deductible before, is now on the table. And it's an above the line deduction, meaning you can take it even if you use the standard deduction. So here's what that means in real terms. If you finance a $30,000 car at 6% interest, you'll pay about $1,700 on interest that first year. And you can now write off that entire amount. Over a 5-year loan, that's potentially $8,000 in deductions. The car just needs to be brand new. You must be the first owner, and it has to be for personal use. Now, income limits do apply. $100,000 if single, $200,000 if married filing jointly. And you're going to want to keep your loan statements and payment records. And remember, this deduction disappears after 2028. All right, so next up, the standard deduction just got bigger, and that means more tax-free income automatically. So for 2025, it jumps up to $15,750 for single filers and $31,500 for married couples. So if you earn $100,000, your taxable income automatically drops to $84,000 if you're single. And that's roughly $3,000 more shielded from taxes than in recent years. You don't have to do anything to get it. It's simply built in. Now, of course, if your itemized deductions add up to more than that, you can still choose to itemize. But for most people, especially renters or those in lower tax states, the standard deduction is now the better deal. In fact, about 85% of taxpayers are expected to take the standard deduction in 2025. If you live in a high tax state, the next write-off could save you thousands, and it's the new SALT deduction that just quadrupled. You see, before you could only deduct up to $10,000 in combined property taxes and state income or sales taxes. Now, from 2025 through 2029, that cap rises to $40,000. So here's an example. If you pay $15,000 in property tax and $20,000 in state income tax, you can now deduct $35,000 instead of being capped at $10,000. That's an extra $25,000 deduction, which could mean $5,000 to $8,000 in real tax savings, depending on your tax bracket. Now, it's especially helpful if you live in states like California, New York, New Jersey, Illinois. Now, it does phase out at $500,000 of income and drops back to $10,000 in 2030. So use it while it lasts. Another powerful update involves charitable giving. If you donate to a qualified nonprofit, your church, local food bank, community organization, you'll now have more flexibility in claiming it. So starting in 2026, two things change. First, only donations that exceed 0.5% of your income count toward your deduction total. Second, even if you take the standard deduction, you can still claim up to $1,000 if filing single or $2,000 if married for charitable donations. Now, that's new. Before, only itemizers could benefit from that. So for donations over $5,000, you'll need a written appraisal. But for smaller ones, just keep your receipts or acknowledgement letters. Now, for the next tax write-off, if you own a home, you'll be glad to hear the mortgage interest deduction is now permanent. You can still deduct interest up to $750,000 of mortgage debt for your primary or secondary residence. And that cap is locked in permanently. You can also deduct mortgage points, private mortgage insurance, and interest on home equity loans used for renovations. You can deduct your principal payments or homeowner's insurance, but this deduction alone can reduce taxable income by thousands of dollars a year. Next, let's talk about a time sensitive opportunity, and that's the solar energy tax credit. This is still one of the most generous energy incentives available, but it's ending soon. You can claim 30% of the total tax system costs for solar panels, water heaters, or battery systems installed before December 31st, 2025. If you install a $28,000 system, that's an $8,400 tax credit directly against your tax bill, not a deduction, a credit. So if your tax bill is smaller, you can carry the remainder forward. But after 2025, this credit disappears for residential systems. So plan early because installation can take months. Another one that's staying put is the student loan and teacher deductions. You can still deduct up to $2,500 in student loan interest for qualified educational expenses like tuition and books. So that begins phasing out at $75,000 of income if you're single or $155,000 if married. And teachers can still claim a $250 deduction for classroom materials they pay for out of pocket. $500 if both spouses are teachers. So books, supplies, software, it all counts. It's simple, automatic, and often missed. Now, here's one of the biggest wins for service workers, and that's the new tips income deduction. You see, for 2025 through 2028, workers who earn tips can deduct up to $25,000 of that income. That includes servers, bartenders, delivery drivers, hairstylists, and more. Say you earn $40,000 in base pay and $30,000 in tips. Normally, you'd be taxed on $70,000, but now you can deduct $25,000, lowering your taxable income to $45,000. That's thousands in potential savings each year. But just make sure your tips are properly reported. Cash tips that aren't declared don't qualify. Speaking of workers, there's also a brand new deduction for overtime pay. So from 2025 through 2028, you can deduct the premium portion of your overtime wages, basically the extra you earn above your normal rate. So if you make $20 an hour and $30 for overtime, that extra $10 per hour is deductible. The limit is $12,500 for singles and $25,000 for married couples. It's designed to help people in industries where overtime is common. So like healthcare, manufacturing, logistics. Just make sure your employer clearly separates your regular and overtime pay on your W-2 and keep your pay stubs. Now, for my retirees, there's a new senior bonus deduction. If you're 65 or older, you automatically qualify for an additional $6,000 deduction or $12,000 for couples. It applies from 2025 through 2028 and begins to phase out at $75,000 of income for singles and $150,000 for married couples. You don't have to do anything special. It's verified automatically through your Social Security record. And it applies whether you take the standard deduction or itemize. All right, next, let's talk about one of the best ongoing strategies, retirement and medical write-offs. You see, for 2025, contribution limits increased to $7,000 for IRAs and $23,000 for 401ks, with extra catch-ups if you're over 50. So if you earn $100,000 and contribute $20,000 to your 401k, you're only taxed on $80,000. If you're self-employed, solo 401ks and SEP IRAs let you contribute even more. So medical expenses are still deductible if they exceed 7.5% of your income. That includes hospital stays, prescriptions, and insurance premiums. And if you have a high deductible health plan, you can open what's called a health savings account. It's one of the most tax efficient tools out there because contributions are deductible, growth is tax free, and withdrawals for medical expenses are also tax free. So for 2025, you can contribute up to $4,300 individually or $8,550 for families. And unused funds roll over year after year. And speaking of families, the child tax credit also remains very strong. It's now $2,200 per qualifying child with up to $1,600 refundable, meaning even if you owe no tax, you can still get money back. There's also a $500 credit for other dependents like college students or elderly parents. The phase-outs remain at $200,000 for singles and $400,000 for married couples. So to recap, here are the 11 major tax breaks kicking in for 2025. The new auto loan interest deduction, a higher standard deduction, quadruple SALT deduction, expanded charitable deductions, a permanent mortgage interest rule, the solar energy credit before it expires, student loan and teacher deductions, a huge new tips income deduction, the overtime pay deduction, the senior bonus deduction, and finally, a higher limit on retirement and medical write-offs. Use even 1/3 of these and you could save anywhere from a few hundred to several $1,000s on your tax return. And if you want professional help applying any of these correctly, check the link below to connect with our team at keepmost.com. I'm Karan with LYFE Accounting, helping you keep more of what you earn through smart tax strategy and education. See you in the next one.